is Personal Finance, Planning for Success. Before we get started, the University of Colorado Boulder, Colorado's flagship university, honors and recognizes the many contributions of indigenous peoples in our state. CU Boulder acknowledges that it is located on the traditional territories and ancestral homelands of the Cheyenne, Arapaho, Ute, and many other Native American nations. Their forced removal from these territories has caused devastating and lasting impacts. While the University of Colorado Boulder can never undo or rectify the devastation wrought on indigenous peoples, we commit to improving and enhancing engagement with indigenous peoples and issues locally and globally. We'll try to do this by recognizing and amplifying the voices of indigenous CU Boulder students, faculty, and staff, educating, conducting research, and supporting student success, and integrating indigenous knowledge, consulting, engaging, and working collaboratively with tribal nations to enhance our ability to provide access and culturally sensitive information and support. Just some housekeeping items. With the panel, we're going to have 3 to 4 minutes, which each panelist will speak. After that, we'll reserve time for discussion and Q&A. We're using a note card system to receive questions from the audience. If you would, they're handing them up around me. If you'd like to pose a question, simply raise your hand at any time, and they will come, write down your question, they will come pick up your questions and bring them up to me, and then we will go through the questions. I'd like to introduce myself first. My name is Peter Braun. I'm a Senior Vice President at UBS in Boulder. I've been here for 31 years doing personal planning, financial planning, and I've been on the Forbes Best in Colorado state list. I'd like to introduce, to my left, Harry Starn. He's a professor here at the University of Colorado and serves as the Director of Personal Finance, Financial Planner Program. He's a certified financial planner and chartered financial analyst. Next, I'd like to introduce Joaquin Cuervas. Joaquin is a senior at Boulder with an emphasis in finance and personal financial planning. And the good news is he's got a job starting with Plant Moran very soon. Look at that smile. Next, I'd like to introduce Kian Saladize. Kian is from California. He works for LPL, which has over 22,000 advisors in the United States. And for any of the students that are here, they do interview for positions, and San Diego's not a terrible place to live. And then I'd like to introduce Carl Cantanilla. Carl is a co-anchor of CNBC's Squawk on the Streets and Money Movers, and he's here because he's a CU graduate. Go Buffs, thank you for coming back. We appreciate having you here. So what I'd like to do is give each of the panelists 3 to 4 minutes to talk about this topic, and then we'll go from there. Professor?
Yeah. Good afternoon, everyone, and I'm delighted to be here to share some ideas, answer some of your questions, and hear from my colleagues on the panel. I've been teaching and working in this area of financial planning for 25 years. And over the last 20 years that I've been teaching at the undergraduate, the graduate level, and also in teaching professionals in the field, I've seen this profession expand, and that's exciting as we're helping people take control of their finances so they can get to where they want to go in a way that they're willing to get there, and helping prepare some of the young adults, as just like Joaquin, to take positions in that field is incredibly rewarding. Now, financial planning itself, whether you're doing it for yourself or working with clients, involves taking control of the pieces of your puzzle. And that puzzle is going to include taking control of your cash, managing your debt, minimizing income taxes, saving for retirement, taking control of your investments, your estate planning, all those pieces, and maybe planning for education. Now, when we're looking at millennials and we're looking at Gen Z generation, young adults who are just graduating, obviously many of those items are already of interest and importance to them. For example, making sure that their catastrophic risks are covered, making sure that they're funding their their school loans, making sure that they're taking advantage of employer plans. But what we're starting to see over the last few years is some of the challenges related to what's happened coming out of COVID. And one of those is the idea that not everyone has a traditional job where the employer is paying weekly salaries or an annual compensation, where they're providing employee benefits, where they're contributing to retirement plans. What's happened is many companies are starting to transition to using self-employed workers. So they're no longer the W-2. That has some real implications for the students coming out when they think, wait a minute, how am I going to replace the missing benefits? How am I going to do work in the gig economy? And so that's really relevant to them as we're thinking about how would they do that? How would they consider replacing those items? Some of the other challenges that we may talk about today include the affordability of housing. As we're looking right there, that's a real challenge to everyone that we're looking at. And so there's a lot of new issues that come out. Now, when we're preparing students to work with the public, and we understand that every client is unique, but what's really interesting, we tend to look for commonalities. We know that a student graduating will probably have student loan debt or may have that, or low in their salary, and that's going to ramp up. So there's a lot of things that are common. And now the conversation, we're starting to understand that as we transition more and more to that gig economy, that's going to even change the impact one more. And I should say this, when I looked at the numbers, we're looking at somewhere between 42 and 45% of those young adults are in fact either having a side hustle or working in where they're coming up with different jobs. And this is really, really relevant. And the estimate is that within about 3 years, we'll be well over 50%. So these are some of the issues that Joaquin, his peers, and those of us in the industry are dealing with. I think that was my 4 or 5 minutes.
It's hard to get 20 plus years into 4 minutes, isn't it?
Exactly, right?
Okay, Joaquin, please.
Honored to be here with all of you on this panel today. I think when it comes to our generation, one thing that really stands out is how easy it is to find topics about financial literacy online. I think now it's more easier than ever. I can simply just go on Instagram, go on YouTube, and find someone giving some sort of advice. But now the problem is, how good is that advice? Because again, anyone could just go online, make an account, call themselves the money messiah, I'll just come in with the name, and say whatever they can. Are they gonna earn a referral if you click on that link that they told you to click on? Are they gonna earn a commission if you buy the thing they told you to buy? And so while I think it's great that financial literacy rates are improving a lot within our generation and within the world as a whole, and that access to information is ever growing, we have to be really careful about who we're getting it from and if it's actually good and trusted advice, which I think makes designations such as a CFP even more important in today's world. Additionally, with our generation, having easier access to those tools, so like I said, I can go on YouTube, look up what's a Roth IRA, how do I make one, and within 30 seconds, 45 if there's an ad, I can find how to make an account, download another app, open up the account, fund it, and be set. So I think that's great because for our generation, the earlier we start saving, the better it's gonna be. And there's just that pressure we have, I think, of saving in a sense because we've grown up going through the financial crisis of 2008 and going through COVID. And so perhaps that will make us a little bit more conservative and not so as trigger happy as it was maybe in 2021. I'm sure, Carl, you can speak on that a little bit more. But no, overall, I think it's great to see financial literacy rates rise amongst this generation, but now it's more a question of make sure we're getting good and trusted information.
Thank you. Kian.
Great, thank you. Excited to be here as well with everyone. And so I've been in the industry for about 20 years in a variety of roles. And I would say we're definitely in a bit of a unique time, especially just coming out of the pandemic, seeing some of the trends that we saw there. And when you talk to Gen Z and just the younger generations, they feel like they're at a big disadvantage, I would say, compared to older generations if you ask them. But what's interesting is underneath that all, they probably are in a better setup as far as just employment goes overall versus maybe 20, 30 years ago. Other factors, but it's really a matter of, just having seen a lot of things over 20 years, you would want to stay the course, stay steady. I would say there's a lot that really hasn't changed since I entered the industry, and of course, growing up at the time that I did. But it's all about saving, as Joaquin said. Always being aware of your budget. The good news is there's no lack of resources out there nowadays for the younger generations to be able to plan appropriately. No lack of information, but again, it's just a matter of how do you parse that, and then along those same lines, being smart about how do you utilize your funds for different things. Loud budgeting is sort of a trend that's come up a lot lately, where people shouldn't feel as ashamed about whether they don't want to spend on some big expenditure, the way maybe in the past it was a little bit different. But I'm excited to be here primarily to just answer questions from people. I've been in a variety of roles that have all somehow tied in with personal finance and financial planning, and also pretty well versed, I would say, on the social media side of things just over the years. And excuse me, just happy to answer whatever questions people might have.
All right, thank you from our stars, now our superstar at the end of the panel, NCU grad, Carl.
I come at it from a slightly different perspective. I don't know if you can tell, I'm dressed a little bit differently than the planners. I'm not a planner. I have a planner, but I do have the perspective of sort of what Joaquin got to, and that is the way in which information has changed and how market intelligence has gotten democratized. Since I got into business news in the early 90s when I went to work for the Wall Street Journal, and I covered business there for 6 years before getting into business television. And it's true, you can find out, especially our focus is on equity investing really, anything about a company or a market trend with a few clicks. And in a way that's amazing, and in a way it really takes people off of their long-term gain. I'm sure we'll talk about the phenomenon of Robinhood and sort of what that did to investor psychology, really coming out of COVID, when people had a lot of excess cash because they couldn't travel, and no reason to spend money on gasoline, no reason to buy new clothes, stuck at home, and a lot of them turned to the markets to play around in things that eventually became known as meme stocks and crypto, and we're now well on the other side of that mountain, but it was a bit of a mania. And I'm sure we'll talk about the lessons that, in aggregate, investors have learned from that. The other thing I would say is a great read recently, last couple of weeks, from BlackRock's Larry Fink, a giant money manager. He writes an annual letter, and this year's letter was a real eye-opener. He talked about the retirement crisis that we have in this country for two reasons. He talks about the collapse of defined benefit and what that means for current generations, but also the fact that we're all going to live a lot longer because of vaccines and better medicine, and if GLP-1s and Ozempic end up having real impacts on public health, your average lifespan is going to grow, and you're going to need a lot more money because you're going to be retired for a lot longer period of time. So those are the kinds of things I think that are creating urgency right now among investors, at least, on how the game plan needs to change in the next, say, 5 to 10 years.
Great. And then if there's questions from the audience, if you could please hand them over. I wonder if anybody would like to talk about, for young people, we've got a tax deadline coming up of April 15th, and what should a young person be doing? Professor?
Well, when it comes to taxes, there are a lot of strategies, tactics you can use to reduce those. Now, if they're looking at doing it right now and we have things 2 days away, it's a little bit too late, right? So what do they need to do? They need to file, and they need to at least and try to pay, and at least file. However, with tax minimization, I think one of the keys is you use some of the benefits given to us by Congress. And what are those benefits? It's to support social objectives. For example, they want you to save for your retirement, so they give you tax benefits. And this is what you would end up doing in October, November, make sure you're positioned to do that, right, as you're looking at it. They want you to form family formation, so they're giving you all types of tax breaks with your home. They want you to provide for your own health care. So they give you and the employer the ability to make a lot of tax advantage contributions there. All three of those end up building wealth over time. So the one thing they still could do is, if they do have the money, they can contribute to their IRA, and probably in their case, either the Roth or the traditional by the 15th. But a lot of the tax planning minimization strategies, you need to think about those in the fall, at least, to prepare for that.
Anybody else want to add on to that?
One of my favorite quotes is from a book called The Pale King, which is a work of fiction, but is about a man who's in the tax business. And I just looked it up because I tweeted it once. If you know the position a person takes on taxes, you can determine his whole philosophy. The tax code, once you get to know it, embodies all the essence of human life: greed, politics, power, goodness, charity. And it really points to the social incentives they're trying to build. I only think about this because I owe some money this year. I just found out. So, but hopefully, you're trying to massage elements of society. But it's true that the things. Think about what the government is trying to tell you, right? They're giving you a hint through the code on what an efficient financial lifespan looks like. So take them at their word. I think listen to them.
And if I got one quick thing, they certainly want you to build small businesses. So if you can do that, even a side gig, there are so many ways to reduce it. And that's probably the number one way, I would say. Would you agree? Yeah.
Yeah.
Great. Anybody else want to add? Or we'll go on to the next one. All right. And I'm going to try to gear most of the questions. I know some of the questions came from people that are asking about retirement, and they're asking about Social Security, but we're supposed to lead towards student-type questions and lead in that direction, but I'm sure people will stay afterwards and answer a couple of those if we don't get to them. Can we talk about emotion and logic and investment choices? A question from the audience, and there's something called emotional intelligence, and wondered if one of you guys want to take a...
Yeah, I can touch on that a little bit. I would say, as Carl alluded to, right, with the proliferation of just all these meme stocks and cryptocurrencies that have become the hot thing now, and it's really difficult a lot of times just to parse out what's going on, what's logical, what's not, in terms of even going back to what they say with irrational exuberance sometimes. So there's a lot of misinformation out there, and really, again, I think it just goes back to utilizing a lot of the same strategies that worked, let's say, even 20 years ago, where you find investments that you believe in, names that really make sense to you, ones that you understand well. Generally, at least for me personally, I don't know how others feel, but I've always really had more of a long-term approach when it comes to investing. So more of a set it and forget it mindset. There's a lot of noise that's out there. A lot of between all the social platforms for the younger generations, it's hard to determine what's a real opportunity and what's not. But really just go with investment strategies that make sense. A lot of times even just index investing is better longer term than trying to do individual stock picking, but it's really become more of a gambling mentality, I would say, nowadays with the younger generation. So just being careful that you don't fall into that trap, because it can get dangerous if you get caught up into it.
I do have one thing. I came armed with one statistic, which I actually got from LPL, Ryan Detrick, who does great work over there. You would talk about emotion, and we're definitely in a hyper-emotionalized political era, and people love to divvy up markets by political eras. What did the market do under a Democratic president? What did the market do under a Republican president? If you invested $1,000 70 years ago and only held it under GOP presidents, it would be worth $27,000. If you took that $1,000 and only held it under Democratic presidents, it'd be worth $61,800. If you invested it the whole time, it'd be worth $1.7 million. If you just forgot about who was in the White House and just kept it over 70 years. When Ryan put that out a couple of weeks ago, I was like, that's just a great stat, and speaks to how much we let emotions get in the way.
Oh, big time. There was a study from Dalbar. Dalbar is a marketing firm out of Canada. And what they looked at was 20 years. I think it was 1990 to 2010. And they said if you had just held the S&P 500, you would have been making about 11.9% per year. And if you just held U.S. Treasury bills, right, risk-free, 3.8. But the average individual investor earned over that period of time for stocks 3.8%, and I think it was 1.6 or something. So if you had just held it, like you said, went to the beach, never looked at it again, you would have beat it by 8% a year. But we also study behavioral finance. Do you want to talk about that? All the issues, the psychology.
Right. No, it's a really important unit, and I'm glad that the CFP board's kind of more focused on it now. It truly is just a whole different aspect of helping individuals with financial planning, because so much emotions run behind this, because it's not only you're helping them with their money, but it's helping them save for their kids' education, helping them save for their retirement. So emotions can definitely play such a big role and such a big job or important part of being an advisor to help manage those emotions and kind of walk them off the cliff that they call you at 3 a.m. worried, panicking about their portfolio. And so kind of what you talked about the kind of set it and forget it, that's the mentality I've taken. I've just have reoccurring investments turned on, I think on weekly or monthly, depending if I have a summer job or not. And I just put an index fund and just kind of set it and forget it, and just like not have emotions kind of take over and not let what I see in the news or on social media just kind of influence what I'm doing, just sticking to the strategy and hoping to retire. Hopefully early.
Does anybody else want to say anything about index funds? Because there were a few questions from the audience about that. Anybody want to add in?
I mean, I guess maybe I'll wait to see what the questions are on that, but one last thing I was going to add is, especially as we're addressing the younger generations, Gen Z, the 25 and under crowd, the good news is that you have, hopefully you're going to have a much longer runway in terms of your investment horizon, so that should help too. I understand as you get to the older generations, maybe you don't have that luxury as much and you have to take a different approach, but when you've hopefully got 40, 50 years in front of you at least, it's a good approach.
Okay. I've got a question from a student. Is Wall Street rigged? What about the dark pools, quantum algorithms? Seems like the system is rigged against us.
If it's rigged, it's the best rig ever to have rigged, because there are so many players that would have to have been in on the game to move it materially. It's mathematically hard to envision. There's also such efficiency in the market where you've got quants and experienced managers, not just here, but in every country where there are markets, looking for the white space. We're looking for the dislocation, looking for the misprice, and just trying to fill it, but in the pennies, in the fractions of a penny. So if it's rigged, then congratulations, because you overcame the law of large numbers.
I'm seeing some nods. All right, Joaquin, here we go. Question for you, and others can add on afterwards. How can a parent bring up issues to their young adults and students without telling them what to do?
That is a tough one, because I definitely was a stubborn teen at times. I know my parents are watching, so you're probably nodding heads right now, like, yeah, yes, he was. But I think it's important not to go with it panicking too much, or not to be worried sick about too much. I think it's really important to bring it up, but maybe just in pieces and slowly kind of integrate them into the thoughts of financial planning and how important it is. And I think part of it is just learning or figuring out what kind of way are they going to best learn. Is it just from you telling them? Is it from finding a video on YouTube maybe and just sharing with them, like, hey, I found this really cool video, you should check it out? Or is it going to be actually going with them, setting the account with them, and leading by example? And so I think it's maybe taking those baby steps and slowly trying to integrate them into the mindset of financial planning and kind of just seeing what their money script is, see what their view of money, if it's the same to yours, if it's different to yours, and see how that's playing out. If they're going out and buying a cup of Starbucks every day, or maybe even two, or if you realize they're kind of a big saver and will keep that piggy bank as full as they can until they go to the bank to cash it in. And so I think it's definitely a difficult question, especially with, like I said, stubborn teens, but taking those baby steps, kind of working with them and not putting too much pressure on it, but just slowly putting your foot on the gas pedal and just easing their way into that kind of mindset and thoughts about financial planning.
Anybody else want to add on? What have you done with your kids?
I think stories can be really powerful. So it's not where you're telling them this is the way it is. You say, this is what I experienced, and this is Joaquin and the other students will certainly know the power of that in working with clients. If you have other clients who have experienced something similar, you can share that. If you experience it yourself, and I think a parent can simply share it with a story. This is what happened to us, and of course that can be powerful. The second one is I think you encourage lifelong learning and financial literacy, right? I think that's incredibly important. Anything, like you said, is there some videos? But I think that could be powerful. Anything, what do you think?
Yeah, no, I agree. So I've got a couple of younger kids. I have an 8-year-old and a 6-year-old, and I feel like, as Joaquin mentioned as well, as soon as you can start teaching them about money and just some of the financial decisions that even they make at that age with things that they want to buy, it's beneficial. You can shape it at a really young age. So I already talked to them just about spending and some of the habits. And let's say we're going out to get some food in terms of, well, you can get this for this price, but hey, if you look at this one, then it might be a better deal. So just getting some of that instilled in their minds as early as possible it's never too young, I would say.
Yeah, I've seen some interesting things on spend, save, give, and for helping children to get started early. You mentioned the latte factor also, or well, I call it the latte factor, getting coffees, and I've seen some really interesting charts where if you take that $5 or $6 or $8 a day and you compound that over a period of time, that as a young person that ends up to being over $1 million by not doing the Starbucks latte. No hits on Starbucks.
Just really quick to add on to that, you brought up the financial literacy as young an age. I actually was curious, so I looked up my high school's course catalog for the upcoming academic year, and they actually have a financial planning course now available, which I think is great. Yeah. They didn't have that when I was there. And no, like you mentioned, it's great to start as young as possible, but then again, is it someone that's trusted and will actually convey the message as strongly as it should be? Yep.
Great. I've got a tough question here from a student that's going to med school, has not had much help from family, and they've got a lot of expenses in front of them. And how does he set up a safety net to cover these expenses? This is a tough one.
Student loans?
He's going to be going to med school and has used his money to get through undergrad, yes.
Yeah, so I can jump on that first if you like. So Albert Einstein once said the most important question, if he could ask, would be, is the universe friendly? And I can tell you when it comes to higher education, our government is friendly. And what is that? The federal student loans are available, and there is incredible flexibility in repaying those. What happens is once that person gets done, the normal schedule is 10 years, every month the same amount, but you can change that. And you can change that when you consolidate that debt and simply saying, well, what I can do is stretch that out to 20 years. I could rather level, kind of like walking up the stairs, that over the years it gets more and more as that person's making more money. They also give you strategic timeouts, that a timeout at a year, you can stop all your payments without going into default. Now, they want to make sure they don't go into default, because then they lose access to any other student federal loans, and it impacts big time their FICO credit score. But having said that, there is ways for them to stretch that out, do it. If they have a problem, do a timeout. And again, it's just simply to understand just how friendly that is. In fact, they even have an ability to pay, but the problem is you have to qualify that for every year. And so that's something they can do. And anyone else? Yeah. there's a lot they can do.
Okay, great. Thank you so much. How about some comments about AI on the markets and the economic system? Because that's certainly been the leading trend here, or leading topic for the last 6 months or more than that, but especially the last 6 months.
We had this morning on our show Andy Jassy, who runs Amazon, and I can't remember exactly how he phrased it, but he wrote a shareholder letter that was published today looking at AI, doubling down on their efforts to fund AI, and he said that it will be as transformative as the cloud, which is still relatively young, but more likely the internet itself. And he said the implications are going to, quote, astound us. Every company that comes on our air obviously talks about it. It almost has to have an AI pitch these days. I know my colleague Jim Cramer has been tooling around with, for example, let's say you have a certain industry CEO on, ask ChatGPT, what should I ask so-and-so? And it will give you feedback. Not always great. My favorite data point on AI this week is that ESPN, or Axios, asked ChatGPT to do a March Madness bracket, and it came in, I mentioned this in a panel yesterday, it came in 13 millionth on ESPN. So it's, there's a lot of hallucinations and all of that, but and the industry's definitely playing with it. It'll be fascinating one day to say to an AI bot, should I buy Microsoft here, right? And if assuming the learning is explosive, maybe one day that answer will be the right one.
I can touch on that a little bit too. So I actually did a classroom visit here yesterday, and the big topic was about AI and what are the implications. So in terms of investing, as Carl said, yeah, I think there are some great potential use cases down the road in terms of it'll help you parse financial data a lot quicker, and you can make more informed decisions. Again, as long as the underlying algorithms are accurate. I would also say it's a blessing and a curse just in terms of as these younger generations are planning ahead with career decisions and prepping for job interviews and other things that you can definitely use it to your advantage if you approach it the right way and try to help you out as you're trying to navigate your own career, I would say. So there's a lot of, I know a lot of times they talk about, oh, it's going to eliminate tons of jobs and all that. I think it's just all about how companies incorporate it into their processes, trying to complement or supplement what employees are doing versus completely replacing it.
Yeah, so building off of that point, I run the Financial Planning Club here at CU, and a big question that comes up to all the guest speakers we bring in is, how is AI affecting your firm? And they all say they're not worried about it in the sense of losing jobs. They actually see it as something that can be supplemental. And so, like you guys mentioned, there's two sides to it. There's good, there's bad. But the people I've talked to in their firms, they're using it to kind of supplement the work, kind of do that background work, but it's not going to take away the face-to-face interaction that people want from advisors.
Yeah, the AI is powerful when it comes to data analytics. We can use that to listen to that meeting, script everything out. You can do it for projections. However, at the heart of financial planning is two things. And one is the strategic financial planning process and the relationship. And that's that human relationship, the experience, the trust that comes out of that. And that's what means that Joaquim's job will never go away, because you will always be there interacting. You're that alpha. Vanguard put it at about 1.5% a year, that behavioral alpha that you bring to the table.
We did a CNBC had an event last year where I got to interview Brian Grazer, who's a big Hollywood producer, and he's produced all kinds of movies over the years. And one of the TV series that he once developed was called Friday Night Lights, which was a big hit on television, which is about a high school football club in Texas. And the question for Brian was, do you think AI could have written that idea, or could AI have written that script? And he said no, because that script came about in my mind when I was kicked off of a high school football team. And no AI is ever going to know what it feels like to have gotten kicked off of a high school football team. Just like they're never going to know if I had concerns about medical school debt. how will it empathize with me? I don't know. I'm not saying that it never could, but that seems like a real leap.
Great, thanks. We've had a number of questions regarding real estate and reverse mortgages, and if people haven't started investing and they're older, should they be going? So I've given you 3 different things to talk about. Real estate being a big, especially for people in Boulder, it's a big part of their assets for a lot of people. Wonder if you want to talk about, Professor?
Sure. So first of all, the reverse mortgage is the question. Okay, so you're right. A lot of people would be cash flow poor, asset rich, with a lot of the assets in there. Now the reverse mortgage, I believe, used to get a really bad rap. And one of the big misconceptions is that if I get a reverse mortgage, the bank owns my house. And that's not the case. You have debt that you would then owe to that company. The reverse mortgage is appropriate when you need additional money to stay in the home. And you say you want so many $100 a month or whatever to help you stay there. So you're simply drawing upon that. When that person passes away, then the heirs could simply repay the bank and they would still own the home if that was the case. So it can become a viable part. And it also adds some flexibility. For example, you deferring your Social Security to 70, you go, well, wait a minute, I need the cash flow. So one of the things that could happen there is a really useful strategy that I had heard one time, and I share with the students, is what if you brought in the reverse mortgage at 62 so that you could postpone Social Security till you're 70, because that will keep going up for you, and then at 70 stop the reverse mortgage and take out the PIA at a larger amount. So now you're moving your pieces in combination. But the home itself, I believe that the reverse mortgage can be extremely valuable. That's sort of a short answer. Yeah. Okay. And please, anyone.
I guess, yeah, I'll just briefly touch on this. I'm by no means a real estate expert, but as a homeowner and just being in the industry, what I would say is, in general, a word of caution with real estate investing is, I think a lot of, especially the younger generations, have this misconception that it's passive investing and it's a great way to generate some returns, and there's not a lot of work involved in it. But I would say it's definitely anything but passive in the end, so just be aware of that if you're going to get into that space.
I have a question from a student regarding precious metals and physical assets. Are they a better way to invest than stocks and bonds? What are your thoughts on precious metals and physical assets? Carl.
I'm not here to give advice on various assets. I mean, everybody can look at what gold's done at 2,300, and you can string out why you think that's happening. If you're that good at buying commodities, then you would have gotten cocoa a year ago. Commodities are, they call nat gas the widowmaker for various reasons. It's just very difficult to time. And like cocoa is a great example of a commodity that's being buffeted by really one specific issue in a very specific part of the world. But no, I don't have specific thoughts on gold. You guys might.
Well, you have holding costs for sure, and there's different issues. I think there's many ways you could participate in the commodities and the metals with the ETFs and that sort of thing. There's a lot of hedge fund-like strategies we can now get access to. But I've never really recommended.
Okay, so not a recommended. I think Jeremy Siegel's book was an excellent book to show the rates of return on different assets, whether it's stocks, bonds, gold, and you see over a long period of time, gold has not had the returns. But in the short term, just like a cocoa, it can do very well. So.
And I can add a horror story. A friend of mine out east, he believed in gold, and he kept his gold in his house. Somebody found out, and they broke in and stole all the gold. The insurance company paid him $200, because that's the maximum you get when you're holding stuff like that in your house. A devastating thing. So if you are going to do that, then you want to make sure it's secure. Kind of scary story.
Yeah, and tied into diversification, if you guys want to talk about that, but to be diversified.
Yeah, that's actually the one point I was going to make is, with anything, as we've already discussed, make sure you understand it before you get into it. I can't really give direct financial advice either, but it doesn't hurt to diversify a little bit. So as long as you understand the risk return trade-off, some of these commodities and other things, may not be such a bad idea just as a hedge. But generally, I would say, if you look at just the long-term track record, it goes back to, I think, just large cap equities or equity markets in general are typically going to be your best bet, I would say, over the long run.
They do pay a dividend, and they have some cash flow you can discount. That's the key.
Right.
Okay, great. Question on ESG. Wonder if someone would like to talk about ESG and how that potentially could affect your returns. So I'm going to give a definition of ESG.
Anybody want that? Okay. So in that case, this is a metric that's really gained a lot of attention. Now, back in the 90s, we had something called socially conscious investing, and that was that people would say, I want to stay away from the, quote, sin stocks, the tobacco, the casinos. But ESG is different. ESG is based on companies that are grading out high when you're looking at their environmental focus, their social focus, the communities, the workforce, and the governance. Is there diversification there? Are the leaders actually focused and caring about the company? So this ESG investing, sometimes referred to as impact investing, is looking at companies that you think are going to then be there for a long time because they're focusing on these three important elements. And so it is a strategy which has paid off, at least recently, as you're looking at that, and it's based on that soundness that you think their intrinsic value, their ability to be there after a long time is positive because of those attributes. Anybody else want to take that, ESG?
I can touch on it a little bit. I remember one of the networking events you hosted, there was one or two firms, I think, that were very specifically geared towards ESG. So it's definitely a growing sector within IRAs and that whole financial planners. And it's definitely gaining traction, and it's becoming more prominent because more people do care about it.
And you can invest in that even with mutual funds, ETFs, that are, in fact, based on ESG.
Okay, great.
Yeah, one thing I'll add as well is I feel like, it's great when you have access to these ETFs and other vehicles now where it's a lot easier to invest in those companies, but also just be careful because I feel like it's become more of a charged political issue, unfortunately, now. So there's two camps. There's the ones that are all into ESG investing, and then there's the other side where they say, oh, that's too woke, as they call it, and they tend to battle each other, and they've come out with funds now on both sides of the argument. But that's why it's important just to do your own homework regardless.
Great. I have somebody that asked a question about how do you use credit to your advantage for someone with problems with impulse spending? Thoughts? Move to the next question.
No, that's a good question. Anybody want that?
No, you can.
Okay. Well, I can get it started, right? So I think the first thing we think about is you had to understand the difference between a want and a need. And so as you're starting to think about the impulse spending that's in there, how do you protect yourself from that? Well, you have to sort of set goals, you set benchmarks, maybe accountability, that transparency with the spouse, if there's one right there, can all come into play a little bit. We know that consumer credit every coin has two sides, right? So on one case, too much credit can be bad, can lead to bankruptcy, can lead to a lot of problems. But on the other hand, it allows us to accumulate wealth over time when properly used. When you're using credit to buy an asset that grows, that's a little different, right? Now, credit cards, I think that's probably what they're talking about here.
Maybe good credit versus bad credit.
Yeah, right. So once you have to understand that right there on, how are you going to use that? And so it's a valuable question, because that idea about budgeting, the word that we don't want to say because it has bad connotations. In fact, I'll ask that in class. What's one word you could describe when I say the word budgeting? And they say, I have to give something up. It's restrictive. And you're not giving up anything. You're really just deciding, do you want to spend it now? Do you want to spend it later? How do you want to use your money? It's your money, right? But let me hand it down here. What are you thinking? What do you guys think?
I mean, my first reaction is to look at the rate on any revolving credit and just envision Visa and MasterCard sort of rubbing their hands together, waiting for that double-digit return on the thing that you could not wait to have. That to me is the real gut check. How badly do you want it? Do you want it badly enough to where you're going to give these entities that extra cash flow? It better be pretty enticing. That's all I have to say.
Yeah, and nothing I'll add. So something that's come up, I'd say, more recently, or it's become more of a hotter trend recently. It's not necessarily even isolated just to the younger generations, but the whole concept of buy now, pay later, that's something I would just say be very cautious about that. Again, understand what you're getting into, because at the end of the day, it is like you're taking out a loan to buy something, and it's still technically debt. Depending on how you utilize it. So a lot of people, I think, just get caught up in that excitement of, oh, this is a great way to buy something and split it up. And I understand it's maybe not necessarily even that much different than using credit per se or a credit card, but I think it can trap a lot of people. So just, again, keep that in mind.
I would add, though, that the American household in aggregate has been pretty good about delevering in these last few years. Yep. You look at debt obligations relative to household income or household assets. I mean, it's near multi-decade lows. It's like the opposite of what the government's done. So you kind of have to give Americans, I think, some credit for, whether it's intentional or not, sort of being somewhat disciplined. And now, granted, there's been all sorts of factors, transfer payments and COVID and lockdowns, but in general, the American household balance sheet is in good shape. And it's nice, having been through things like the financial crisis, when we really got over our skis on housing, for one example, to see the opposite of that.
Yeah, I was going to bring up also the buy now, pay later. That's been coming up way more. I always see it when I'm buying something online. There's always that option there. And so you got to watch out for those things. And going back to distinguishing need versus want, because we've talked about a lot of that in class, and that goes back to the behavioral part of financial planning. And so it's very important to distinguish what's a need, what's a want. And one practice I do for myself, it's if I can't distinguish if it's a need or want, I kind of give it like 2 days. I was like, all right, like I'll come back to this in like a couple of days. Do I still want it as bad, or was it just oh, it looked cool, let me get it now? And it can be tempting, because you have stuff such as the iPhone coming out with a new version every year, so it can be tempting to you see a commercial that says trade in your new phone, get a new one. And so there is a lot surrounding our culture and consumerism about pushing out to just keep buying, and just have that impulse reaction to it. But sometimes you just got to kind of take a step back, give it 48 hours or more if you need to, and really distinguish if it's a need or want.
Great, thank you. Question about a student, Roth IRA or IRA? I'm assuming most students are in a lower income bracket, hopefully, than they will be later in life. Somebody want to take that?
You want to take it?
Yeah, I'll take it. I have a Roth myself, and kind of as you mentioned, it's due to the lower tax bracket. So as how a Roth works, you put in money that's already taxed. So since I'm in a lower tax bracket, since hopefully I will be making more money as I progress through life, I can put in that money now that's been taxed at a lower rate, have it grow tax-free, and I can take it out tax-free once I decide to retire. Versus a traditional where it's pre-tax and then you're taxed once you take it out. But I would say the Roth is definitely better, I think, for our generation, just because, as you mentioned, we're in the lower tax bracket. We're not being taxed as much on what we're making. And so if we can have that less tax money grow tax-free for even longer periods of time, it'll be super beneficial by the time we retire.
Anybody else?
Yeah, I mean, just to add on, it's a smart move the younger you are, because eventually, I mean, the hope is that as you earn enough, you'll get phased out of even being able to contribute to something like that. So get in while you can.
And the compounding effect of having that grow tax-free over 40, 50 years is really makes a big difference. Question about credit cards. Anybody want? How do you pick which credit card you might want to have or not have? I guess is also could be the case.
Well, the average American has about 3.2 credit cards. And one of the activities we'll do when I teach a financial literacy class is we'll go online and take a look at what, for example, creditcard.com, websites like that. You can take a look at what are the different categories. Now, you understand if you have the plain vanilla credit card, it will be the lowest interest rate, but there's no perks. So then you're saying, well, wait a minute, I like mileage back. I would like to have money back. I'd like to do an affinity card where my institution gets some money. Then it kind of goes up from there. So one of the ideas would be that you would go online, take a look at what would be best for you, and then look at the comparable rates. And all that's available, bankrate.com, another one that's really good right there for those insights as you're looking at it. So you start to choose that. Now for the students, many times they need to get a credit card because that starts the FICO credit score running. And FICO credit score is really important getting loans later. So we'll look at some of the top student credit cards out there. And have you done that? Do you have a credit card?
I do.
Yeah.
I do.
And how did you decide on yours?
I kind of asked my parents for help. I would get letters in the mail and she was like, what do you think of this one? What do you think of this one? And we ultimately decided on one that didn't have an annual fee, but would also give me some cash back. But then one thing we looked out for wasn't incentivizing me to go out and spend money. We didn't want one that was like, oh, you'll get all these perks, but you have to like go spend this money. Because if I don't need to spend the money, then I'm not going to go and spend it just to get a reward. Because even, let's say it's a $10, $20 reward, but I had to spend $100 to get it, I didn't really save the 20 bucks. I still spent 80 to get the reward that in the first place I didn't even really need.
That's good.
Question: are ETFs always better than mutual funds?
I guess, yeah, I can touch on that a little bit. So I actually, before my role at LPL, I spent about 6 years at an ETF firm. So I'm a little partial to it, I guess, but I would say in terms of just overall fees and accessibility, generally, yes. Granted, it does depend on the investment and the focus and underlying methodology and so forth. But yeah, I would say that especially for the younger generations, there's always the fee wars that are going on between the big issuers, and the good news is now you can access even S&P focused ETFs that have a zero fee associated with them, at least in the short term. So it's a great way to just get yourself into the market. You don't have to worry about buying a bunch of individual stocks, and there's a lot more attention, I would say, being paid to that. Mutual funds haven't gone away by any means, and I deal with a lot of financial advisors who still utilize them pretty heavily, but again, especially for the younger generations, I think there's a trend that they're starting to move a lot more towards ETFs, and you can find a lot of great options with a lot of great specific focus areas or themes, as we call them, that could be pretty beneficial for you at a pretty low cost, I would say, right now. And I don't know, I can't speak as much, I guess, in terms of the tax implications and all of that, but yeah, just in terms of the premise of what it gives you, I think ETFs are great overall.
All right. Question regarding Social Security. Take it now, take it later. Will Social Security be around? I get a number of these questions at work also. Anybody want to talk about that? Obviously, everybody's situation is personal, and so that's where they need people like Joaquin to help them out with these kind of things.
I can start us off.
All right.
So again, going back to the club I run, a lot of the guest speakers, a lot of students will ask me the same thing regarding Social Security. They all seem pretty confident about it. That's not going anywhere anytime soon. So that's their words. Don't shoot the messenger. And in terms of when to take it, Professor Starn covered a lot in our retirement planning class, but there's a lot of benefits or pros and cons to each one if you want to take it early, take it on time, or take it late. And so it definitely does depend person to person whether or not you need the cash flows yet, or if you can wait and kind of get a little bit more, get the extra 24%, right? If you wait up to 3 years.
Yeah, so it'd be 8% a year.
Yeah,
Plus inflation.
plus inflation.
Plus inflation.
Plus inflation.
And
then
so
you start at a higher.
right. It definitely depends person to person, and just once you get to that age, what your cash flows are looking like, and if it's something you can pull now, or you think you can wait a little bit and then pull later.
I think many advisors, to be conservative for their clients, will just simply project in, what if you only get 70% of your Social Security benefits? So they'll use that in helping people figure out how much they need to save. Now, one of the things, and of course I could be wrong, but the idea is when you have over 60% of the population, their major source of retirement income is Social Security, I can't imagine it's just going to disappear. However, there's some short-term fix as that pig through the python. That's my group, right? Moving through that as more people are taking money out than in, implications. However, like you said, if you don't need it, there's some advantages to waiting till 70 because it keeps going up each year. And the thing I think of it this way, are you looking at just the dollars, or are you looking at the insurance element of it? Because the surviving spouse, if you're looking at a couple, steps into the shoes of the person with the higher PIA when the person dies. So in my case, when my dad had passed away, then my mom would step into his. But he took it at 62 when he really didn't need to. So there were some long-term implications of that as we're looking at it. But it's an important subject, like you said, because if you can postpone, the PIA keeps going. That means the primary insurance amount, what you get every month, goes up. And then you start at a higher amount, and every year it adjusts after that too. So I would say that. But that's the psychology of financial planning. How will Joaquin talk to his clients in the sense of postponing it when there is some uncertainty? That's a big, big deal. That's the psychology of what we do, the art of what we do, right? Yeah.
Not only the science, but the art.
Yeah.
They go great together.
And the other element is, can you tell somebody when you're going to die? Because that will help determine.
That's extra. That's an extra fee.
That will help determine when you're going to take Social Security. Question about private equity. Can anybody invest in private equity? Can anyone invest in private equity? Thoughts on that from anybody at the table? Generally.
Well, I can take it. So in that case, private equity means like you could invest then in maybe a local company or something like that, right? So high net worth individuals are called qualified investors, right? So if you have a certain amount of money or you're a certain type of institution, you could. So in that case, if we take a look at an accredited investor and they've got $1 million of assets exceeding their home, or if they're married and are making $300,000 a year for the last 2 years and this year, then in that case, they would be able to do that. So what will happen is when you have, do you have any of the family, what do you call it?
Family offices.
Yeah, Did they come in?
Yes. Yeah.
So when the family offices, they're typically working with families with anywhere from 10, 30, $90 million of assets. They will certainly bring in private equity and a private debt. Having said that, not everybody can.
I mean, it's it is, there are barriers to entry, obviously, because of the requirements you need on your net worth. It's actually a big source of frustration for, I think, investors at large, that there are these opportunities out in venture capital and private equity that are kind of off limits, and in a sort of tepid IPO market, where are the easy avenues to invest in hyper growth? And so when an IPO does hit, everyone piles in, it goes to the moon on day one and then sells off. People are bitter about that. SPACs, another classic example of people just hungry for early stage growth. And they felt like they weren't allowed to play, so this SPAC model got revived, and we went through a period too, along with memes and crypto and NFTs, that sort of led to excess risk. So it's, structurally, I can see how it's frustrating for investors because you see the money that private equity makes, and there's a growing sense of why can't I be a part of that?
All right. I had a couple questions around insurance and annuities, and again, this all applies to each person differently, I'm sure. But wonder if you guys would like to take on any of those, and long-term care. I think you can throw all of those into the insurance bucket, if you will, and speak to those.
Anyone want to get started? Okay, so with insurance, and for insurance here, we're just everything, right?
Yeah, overall insurance, and then how do annuities
So
like them, don't like them?
a few years ago, somebody came in to offer a CFP exam prep review class for our students. Now we do that internally, and Joaquim's going to be going through that in May. But he had said, if it hurts to write the check, you have to transfer out the risk. And that was, I thought, a prudent comment, and so I said that. That's transferring out to insurance companies. So there, what are you thinking about? Well, one, we have to think about things like loss of health care, and of course, you're probably getting that through your employer, I hope. And if not, Medicare, as you're looking at it. And then from there, loss of income. And how does that happen? Disability. So that's something that's a really big key right there. Running out of money. Now, when you're running out of money, what could you do there is one, well, you could save more, but the other one is annuities, right? So annuities that you mentioned, so I'll stop there. And then
And there's different types of annuities.
Yeah, there's different types of
very wide range of annuities.
Yeah, and to be quite frank with you, I never had invested in annuity because the rates were real low. And then one day during COVID, I'm listening to a webcast, and the light bulb came on. And the person said, yeah, but if you choose a life payoff option, which means it will continue to pay throughout your lifetime, and you outlive your life expectancy, now your ROI starts to accelerate up. And I go like, oh my goodness, there it is. So for the person who dies 2 years after they retire, 10 years before the statistics say they don't earn anything. But another way it goes from there. But if you're a senior, if you're 60, 70, you have to be very careful about that. And I would say to Joaquim, don't ever sell an annuity to somebody in their 70s or 80s, because there's surrender charges and there's all sorts of fiduciary issues that come into play. But for somebody, that annuity could be a decent deal. Now, talking to the millennials, the Gen Z who are maybe tuning in remotely right here, it's important. So when you graduate, when you need to make sure you're covered with your auto and your home and your liability insurance. These are the different issues. You can't leave yourself catastrophically exposed. Now, you studied all this. Do you have anything you would add?
No, I mean, you always emphasize to us in the class how litigious of a society we live in. So it's very important to get that auto, get the professional liability, and also umbrella if you need it. And it's just super important not to also take away from disability. Disability insurance is also very important.
Yeah.
Other thoughts? Okay.
Ken, you have E&O insurance, right?
Yeah, we do. I mean, so one thing maybe I will add is just in general, as with everything else, depending on what generation you're in, always do your homework with this kind of thing. I would say there's a lot of information out there, and just it seems like it's become sort of a heated debate between financial advisors who get people invested or sell them on these annuity and insurance products, and the ones that don't. And I feel like they've kind of turned into two distinct camps, and you've probably seen this as well just in the various social media platforms now. So, just, again, make sure that you know all the considerations with it. Is your financial advisor considering your best interests with these kinds of things? And what are all the fees, the implications, and so forth? But yeah, definitely at a minimum for the younger generations, you want to make sure you have the right insurance coverage for those key items.
If I could have one more thing. Anybody here approaching Medicare, I would highly recommend that you look at Medigap insurance. A lot of people think Medicare covers everything. There's a lot of holes. You have deductibles, a limit on the number of days. You have co-insurance, which will be 20% of the bill. That Medigap fills that. In fact, I was at a conference one time, and there was a woman talking about it. And it's the first time I had ever seen anybody talk about it. So that, after a while, that's what you look for. Something you haven't gone to 6 other times. And afterwards I went up, I said, could you ever think of a situation in which you would not recommend Medigap for someone? And she went like this, and she looked at me and said, no, for everybody. And so I would certainly consider that, and we studied that about how do we cap the unknown healthcare costs, which could be devastating.
Right.
The only other code I'd add is like auto insurance right now is a real source of pain on the inflation front. I don't know if you remember, during COVID, there was a period where insurers were giving money back because no one was driving anywhere. Now it's like the locus of the pain in this most recent CPI print that we got yesterday. I mean, the charts annualized on insurance rates in cars is insane. So occasionally you hear the president give grocery chains a hard time about greedflation, but you might increasingly see that the barrel of that gun turned toward the insurers.
Great. We have a couple questions here that are somewhat personal related. I'm sure the panel would be willing to take those on outside after this is over. I don't want to have them go on this, but if does anybody want to add maybe a 30-second, 60-second wrap or a main idea of personal finance and your thought, or a quote, or whatever it might be along those lines.
We did a panel yesterday about corporate leadership, and a woman on the panel had a great line. She said, "There's no compression algorithm on experience." In other words, you can't accelerate your knowledge that you're going to accumulate over your lifespan, and that's kind of so true when it comes to personal finance, because no kid wants to listen to another old person give them lessons about how to be responsible, and just you wait, you'll see when you're older. I mean, it's literally, that's what it sounds like. But the lessons are kind of universal and eternal. Save aggressively, kind of don't look at it, don't get, as we said earlier, emotional about it, and let the compound work for you. So in a way, the challenge is moving beyond the cliches. I don't know how you guys do it, but that education process over and over and over with new clients, young clients, must be difficult, but it's an important education.
Professor, do you want to wrap it up here for us and give your final thoughts?
Sure. You know, I think personal financial planning is you simply saying, I'm in control of my money. You decide exactly what you want to do with it, and that frame changes everything, and you know knowledge is power. So the more you learn about it, the more, as Joaquin said, you find a good source of information, somebody, and if you're getting an advisor, somebody who cares about you and has high ethics and brings some of this knowledge, that can change everything. But that's what I would say. It's your money, and you can take control of it, changes everything.
Great. Thank you so much to all the panelists. Thank you to the audience for being here and participating again. We'd be happy to answer any individual questions after this is over. Thank you.